On Tuesday afternoon in Iowa, President Donald Trump told reporters he was not concerned about the recent dollar decline, saying, "I think it's great, and the dollar's doing great." Yahoo Finance, as the currency plunged to its lowest level since early 2022. Within hours, the Bloomberg Dollar Spot Index extended losses to as much as 1.2%. Yahoo Finance, and what had been a controlled descent became something closer to capitulation. Gold immediately surged past $5,000 per ounce. Treasury yields spiked. And in trading rooms from London to Hong Kong, the same question ricocheted through institutional desks. What exactly did the president just reveal? The answer, for those who understand how reserve currency systems destabilize, is everything. This was not a policy statement. It was a confirmation of structural inevitability already in motion. The dollar is not collapsing because Trump spoke. Trump spoke because the dollar's role is already unraveling, and the administration has chosen not to fight it. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. To understand what Trump revealed, you must first grasp the scale of what is actually happening right now. The ICE US dollar index was already on pace to record its worst three-day drop since Trump's April 2025 Liberation Day tariff rollout. Before his comments and after he spoke, the value of the dollar, as measured by the index, sharply extended its slide to as much as 1.5%, putting it on track for its worst one-day drop since April. NBC News. This is happening as the dollar has suffered a roughly 10% decline over the last year due to erratic policies from the Trump administration. Euronews. We are not discussing normal currency fluctuation. We are discussing a confidence event playing out in slow motion across the world's most important financial instrument. The dollar's share of global foreign exchange reserves has dropped to its lowest level since 1994, declining toward the 50% line. Wolf Street, meaning central banks worldwide are systematically reducing their exposure to dollar-denominated assets even as they continue to hold them. The movement is gradual in data, but explosive in implication. The professional investment community understands what is occurring. J.P. Morgan Global Research is forecasting gold prices to average $5,055 per ounce by the final quarter of 2026, rising toward $5,400 per ounce by the end of 2027. J.P. Morgan, and these are not speculative price targets. They represent the institutional consensus on what happens when the primary global reserve currency loses predictability as a store of value. Gold surged to a record high above 5,280 an ounce on Wednesday, extending a breakneck rally fueled by U.S. dollar weakness and a flight from sovereign bonds and currencies. Bloomberg. This is the debasement trade in full acceleration. Investors are not buying gold because they believe it will generate returns. They are buying gold because they no longer trust that holding dollars or dollar-denominated debt will preserve purchasing power over any meaningful time horizon. What Trump revealed in Iowa was not uncertainty, it was acceptance. When a sitting U.S. president says a significant currency decline is great, while Treasury Secretary Scott Bessent has highlighted the distinction between the dollar's price and its value as a reserve currency. Yahoo Finance. The message to global reserve managers is unambiguous. The administration will not defend dollar strength. This is not a conspiracy. It is policy expressed through strategic indifference. The U.S. government is trading reserve currency stability for short-term export competitiveness, and it is doing so at precisely the moment when the structural costs of that trade are compounding exponentially. The mathematics of this situation are not speculative. They are already visible in government data. Under the tariffs imposed and scheduled as of January 23, 2026, the weighted average applied tariff rate on all imports rises to 14.0%, the highest average rate since 1946, and the Trump tariffs are the largest U.S. tax increase as a percent of GDP, 0.55% for 2026, since 1993 Tax Foundation. These tariffs raised $132 billion in net tax revenue in 2025 tax foundation, but they are simultaneously destroying the very system that made dollar dominance economically sustainable. Trump's erratic policy shifts have driven overseas investors to pull back from the US, and the dollar's drop has been fanned by Trump's unpredictable policymaking, which has rattled overseas allies and investors' Yahoo Finance. When the United States uses tariffs to coerce trading partners while simultaneously expressing comfort with currency weakness, it is teaching the world a lesson in game theory. Holding dollars subjects you to arbitrary policy risk with no compensation for that risk. The response from global capital has been methodical and irreversible. In late November 2025, Standard Bank became the first on the African continent to link directly into China's cross-border interbank payment system Al Jazeera, providing a concrete alternative to dollar-based settlement for trade flows. The dollar's declining market share has not yet led to the rise of a single alternative reserve currency, as the gains are going to non-traditional currencies like the Australian dollar, not to the euro or yuan. So it's not that the dollar is losing its position, but losing its monopoly, and doing so without a clear replacement, US News and World Report. This is the most dangerous possible configuration. If the world were shifting to a single new reserve currency, that would represent an orderly transition. Instead, we are witnessing fragmentation. No single currency can replace the dollar's role because no other economy has the depth, liquidity, or institutional credibility. But that does not mean the dollar retains its position. It means we are entering a period where there is no dominant reserve asset, only a mosaic of hedges and diversifications. History provides precise analogs for what happens next. The British pound lost its reserve currency status not in a single crisis, but through decades of fiscal profligacy, geopolitical overreach, and policy inconsistency that slowly convinced global creditors to seek alternatives. The process accelerated when the British government repeatedly demonstrated it would prioritize domestic political considerations over the stability of the currency. By the time the Suez Crisis of 1956 forced a humiliating British retreat because the United States refused to support the pound, the outcome was already determined. The crisis was not the cause. It was the revelation of a structural weakness everyone already understood but had been unwilling to acknowledge publicly. What Trump said on Tuesday was America's Suez moment. It was the public acknowledgement that the U.S. government will not sacrifice domestic political objectives to maintain dollar stability. Every foreign central bank reserve manager heard that message with perfect clarity. Most people miss what is happening because they are watching the wrong indicators. They see that in 2022, the greenback dominated 88% of traded foreign exchange volumes, and the Chinese yuan made up just 7%. And the dollar's share in FX reserves was lower in the early 1990s. So the recent decline to just under 60% is not completely out of the norm. JP Morgan. They conclude the system is stable because transaction dominance remains intact. This is the equivalent of judging a building's structural integrity by counting how many people are still inside. What matters is not current occupancy, but the rate of exit and whether exits are accelerating. De-dollarization is unfolding in central bank foreign exchange reserves, where the share of USD has slid to a two-decade low, and in fixed income, the share of foreign ownership in the U.S. Treasury market has fallen over the last 15 years, pointing to reduced reliance on the dollar. JP Morgan. These are not marginal adjustments. They represent a fundamental recalibration of how the world prices risk. The fiscal dimension of this crisis is where theory becomes catastrophe. JP Morgan Chase CEO Jamie Dimon has identified the ballooning national debt and volatile global politics as two tectonic plates that threaten to destabilize the financial order, cautioning the current U.S. fiscal trajectory is not sustainable, and these shifting forces may crash in the near future, as the gross national debt has surged to roughly $38.4 trillion fortune. The critical variable is not the size of the debt, but the interest expense required to service it. According to Treasury data, in the 9 weeks since the start of fiscal year 2026, the government has spent $104 billion in interest on its $38 trillion borrowing burden. which is more than $11 billion a week and already represents 15% of federal spending in the current fiscal year fortune. At an annual rate, interest expense is approaching $1.2 trillion. This is higher than the entire defense budget. The mechanics of how this destroys the dollar's reserve status are not intuitive, but they are mathematically certain. When a reserve currency issuer runs sustained fiscal deficits, foreign creditors must continuously increase their holdings of that currency to absorb new debt issuance. This works when the currency is stable and policy is predictable. It breaks when policy becomes erratic and the currency weakens. Chris Weafer, an investment analyst, says political changes in the U.S. have led to distrust, noting that President Trump's lack of predictability and the huge U.S. debt of more than $38 trillion mean that the U.S. dollar is not as safe or as predictable as it used to be. Al Jazeera. Foreign central banks are not selling dollars because they have found better alternatives. They are reducing exposure because holding dollars at current debt levels with current policy volatility imposes actuarial risk that no longer generates compensatory returns. The second order effects are already visible in commodity markets and trade finance. De-dollarization is most visible in commodity markets, where a large and growing proportion of energy is being priced in non-dollar denominated contracts. JP Morgan. This is not about ideology. It is about risk management. If you are Saudi Arabia or Russia or Brazil and you price oil in dollars, you are exposed to dollar volatility. If the dollar weakens 10% in a year while your costs are in local currency, you have just taken a 10% revenue cut through no action of your own. The rational response is to negotiate contracts in a currency basket or in your own currency. Once that happens, dollar demand decreases structurally. Each barrel of oil no longer requires dollar settlement. Multiply this across global energy flows, and the dollar's transaction dominance begins to erode from the foundation. The tariff regime compounds this process by destroying the reciprocal trade flows that created dollar demand in the first place. During the first 10 months of 2025, U.S. imports from China declined by 27%, the largest bilateral decline observed among all U.S. trading partners, as tariffs on Chinese products were imposed immediately. The conversation. When the United States imports less, foreign exporters earn fewer dollars. When they earn fewer dollars, they need to hold fewer dollars in reserve. Although the U.S. is the world's largest economy, it is responsible for just 13% of global goods imports and just 9% of exports, so Trump's targets around the world have been able to shrug off turbulent American trade policy time. The United States is large, but not large enough to force the world to accept perpetual policy chaos. The rest of the world is adapting by reducing dependence. Why does this cycle accelerate faster than previous reserve currency transitions? Three factors are converging that did not exist in prior episodes. First, communication technology allows real-time coordination. When British pound weakness became apparent in the mid-20th century, it took years for global financial institutions to coordinate alternative arrangements. Today, China and Brazil can negotiate yuan-denominated trade settlements in weeks. Standard Bank became the first on the African continent to link directly into China's cross-border interbank payment system, Al Jazeera, and that infrastructure change enables immediate reconfiguration of trade finance across an entire continent. The speed of systemic change is no longer limited by information flow. Second, alternative payment infrastructure now exists at scale. The Society for Worldwide Interbank Financial Telecommunication, SWIFT, was the primary mechanism for dollar-based international payments because there was no alternative. That is no longer true. China's CIPS system, the European Union's efforts toward a digital euro, and bilateral currency swap agreements among BRICS nations provide functional alternatives for an increasing share of global trade. These systems are not as liquid or as deep as dollar markets, but they are sufficient for countries seeking to reduce dollar exposure incrementally. Third, the United States itself is teaching the world that dollar access is a political tool, not an economic constant. Biden's sanctions on Putin, his aligned oligarchs, and the Russian state were far more aggressive than anything any president, including Trump, had ever done with the dollar, and informal conversations with Biden officials suggest that they had noticed that despite Trump's actions, other countries had not moved away from the US dollar, so the Biden administration felt the US had greater leeway to use sanctions medium. When sanctions become a routine policy instrument, every country must calculate the probability that it could be next. The rational response is to reduce exposure before it becomes necessary. This is not anti-American sentiment, it is fiduciary prudence. The human impact of what happens next is not abstract. When a reserve currency loses dominance, the issuing country loses the ability to borrow cheaply. Being the dominant reserve currency had the effect of helping the US borrow more cheaply to fund its huge twin deficits, the trade deficit and the budget deficit, and has enabled the US to run those huge twin deficits for decades. But at some point, this continued decline as a reserve currency would make the trade deficit and the budget deficit more difficult to sustain Wolf Street. If U.S. Treasury yields increase by even 1 percentage point due to reduced foreign demand, the annual interest expense on $38 trillion of debt increases by $380 billion. That is more than the entire budget of the Department of Education. The government must either cut spending, raise taxes, or accelerate money creation to cover the shortfall. All three options impose real costs on American households. The most common objection to this analysis is that there is no alternative to the dollar, so global markets have no choice but to continue holding it regardless of policy. This argument confuses necessity with sufficiency. It is true that no single currency can replace the dollar's functions across all use cases, but that does not mean the dollar retains its privileged position. What happens instead is diversification without replacement. Central bank and investor demand for gold is set to remain strong, averaging 585 tons a quarter in 2026, with around 755 tons of central bank purchases expected in 2026, still elevated compared with pre-2022 averages, which were closer to 500 tons JP Morgan. Central banks are not choosing between dollars and yuan. They are choosing between dollars and a portfolio of yuan, euros, gold, and other assets. Each marginal shift reduces dollar demand. The process does not require a replacement. It requires only that each incremental allocation of new reserves goes disproportionately to non-dollar assets. Another objection holds that dollar strength or weakness is cyclical, and this decline will reverse when growth differentials favor the US again. This argument ignores that what is happening now is not primarily about growth or interest rate differentials. A big part of the reason the dollar has been the world's reserve currency is because US economic policy has been predictable, has been process-oriented, and has been rules-based. And right now, all three of those are sort of up in the air, Alliance Bernstein. When reserve managers lose confidence in policy consistency, they do not return when growth improves. They permanently reduce exposure because the volatility itself has become unacceptable. Insurance premiums do not decrease after the house has burned down. The convergence is what makes this moment structurally different from prior dollar weakness episodes. We have simultaneous fiscal unsustainability, policy unpredictability, currency weakness endorsed by political leadership, tariff-driven trade disruption, and the emergence of alternative payment infrastructure. In 1979, the dollar weakened, but policy was still predictable. In 2008, policy became unpredictable, but the dollar was still the safe haven. In 2026, we have both conditions occurring together, while U.S. political leadership actively signals comfort with dollar weakness. The combination has never occurred before at this scale. The forward-looking implications are visible in how institutional capital is positioning. Investors have been pouring cash into assets like emerging market funds at a record pace as momentum builds for a rotation out of U.S. holdings more broadly, a move some have called quiet quitting, Yahoo Finance. This is not panic selling. It is methodical reallocation by sophisticated investors who understand that the risk-return profile of dollar assets has fundamentally changed. When the President of the United States says he is not concerned about currency weakness, while gold breaks $5,000 per ounce and the federal government's interest payments on debt are on track to top $1 trillion in fiscal 2026, crowding out other priorities and making it harder for future Congresses to respond to emergencies. Fortune, the message is unambiguous. The U.S. government has chosen to prioritize export competitiveness and domestic political considerations over reserve currency stability. That choice has consequences that compound until they become irreversible. What Trump revealed on Tuesday was not a policy shift. It was acknowledgement of a structural reality already in motion. The dollar is losing its reserve status, not because of what Trump said, but because the fiscal and policy foundations that supported that status have eroded beyond repair. The president simply confirmed that the U.S. government will not attempt to reverse the process. For those who understand how reserve currency transitions accelerate once they begin, that confirmation is everything. The mathematics are already determined. The only variable remaining is how long it takes market participants to fully internalize what has been revealed. History suggests that once a reserve currency issuer publicly signals indifference to currency stability while running trillion-dollar interest expenses on unsustainable debt, the timeline compresses from decades to years. We are no longer in the early stages of dollar decline. We are in the late stages of denial before the acceleration becomes undeniable to everyone watching.